From here onwards and into 2019, Harsha Upadhyaya, CIO Equity at Kotak AMC, joins us on the show right now. Harsha, hi, morning. Good to have you on the show. Harsha, just given how the global markets have performed and the fact that if you were to quantify how much they've fallen from the 2018 highs, most markets like a Shanghai, S&P, they're all already into bear market territory. Would you believe that India would continue its show of resilience because of the cool-off in crude? Or do you think there is a fair chance that we may actually fall prey to their weakness and actually see a catch-up and some selling coming in?
Good morning. As far as we are concerned, I think the significant fall that we have seen in crude, which is almost about 40% from the peak, is a significant positive. I think our economy as well as corporate profitability will start looking up based on the fall that we have seen in crude in other commodities. Clearly, we have kind of been resilient to what's happening around the world. But I guess for the first 6 months of 2019 at least, we would remain more volatile, and once we get clarity on the political scenario, I think our markets can significantly outperform other markets, because the fall in commodity prices is a significant positive, and if it remains so for the next 6 months or so, we should be able to really outperform other markets.
On the other hand, you're not completely ruling out the fact that the worst may be yet to come, and what we've already seen is not something, the worst is not behind us, basically.
In the very short term, usually liquidity and sentiments drive markets rather than fundamentals. While we are positive from a fundamental basis that Indian economy as well as corporate profitability will start to look up, but in the very short term, we would be driven by a lot of sentiments and liquidity scenario, and that is not looking too bright. So that's why I would tend to think that markets can remain volatile in the short term. And also locally, we have a political event coming up in the next few months. So to that extent, we may remain sideways at best and more volatile.
Right. But, you know, some data which has been floating around the market, Harsha, believes that, you know, the correlation with an election event is not as much as one anticipates it to be. So historically, markets on a financial year basis and on a calendar year basis, in the year of the election, have actually done quite well.
Yes, I'm not saying that elections will make a huge impact on a 3-year or a 5-year return, but in the next few months, I think the noise is going to increase in terms of what political scenario is going to develop. So to that extent, I really don't think that India will outperform other markets given this particular event. Once we get over that event, I think people will start looking more towards a fundamental strength that is there in our economy. And also we believe that financial year 20 will be a year of earnings recovery. We are expecting about 20% plus earnings growth for our market. So given earnings growth as well as clarity on the political scenario, I think our markets then will start to outperform other markets.
Let me try and reframe this question. What, as a portfolio manager and, you know, as CIO Equities, are you telling your team to be your portfolio strategy in the first 6 months versus post-elections? What are you doing with managing your portfolio in terms of the allocations that you're making, underweights, overweights, cash levels into the first half of the year versus what you plan to do rather in the second half once there's clarity on elections?
Two things. Firstly, I think the entire 2018 was driven by more driven by consumption-led stocks, and almost all of the consumption-led stocks have performed very well, and the valuations have become rich. And also, we are seeing at the margin some tapering of growth in consumption-led segments. So overall, we remain a bit cautious getting into 2019 on consumption stocks. We believe that the valuations are not in our favor, and hence we need to be cautious on that segment. Secondly, we believe the mid and small caps, which have corrected sharply from the peak levels of January 2018, have started to look attractive. Not the entire basket, but at least on a stock-specific basis, there will be many mid caps and small caps which will grab our attention from here on, and that's where we are building our position. So overall, portfolio construction will be a lot more balanced between consumption and infrastructure, unlike which was only in favor of consumption in the previous year. And also in terms of the multi-cap strategies, we would look at adding some of mid caps and small caps going forward.
Okay, that's interesting. So Harsha, where within small and mid caps are you hunting? I'm guessing it would be a very stock specific approach.
It will be entirely a stock-specific approach. We are looking at companies where there has not been much of a fundamental change in earnings trajectory, but stocks have fallen from the highs of 2018. So that will be the basket that we will like to zero in on. And over a period of time, given our expectations on the market that markets would remain at best sideways or may even go lower, we would find opportunities to actually increase our mid and small cap allocation in our funds.
Okay. Any particular sectors that are seeming attractive, or any themes specifically with regards to small and mid caps that you do find attractive? I know you can't talk stocks, but at least give us a hint on the themes that you're tracking.
Not just on the mid and small cap basket, but overall we remain positive on capital goods, engineering and cement, where we believe the current growth rates would sustain, and also if we get a stable government, we should see some acceleration in terms of order flows and execution pace. And also we have seen significant correction in commodity prices, which should augur well for some of the manufacturing industries on the capital goods and engineering segment. So overall, we remain bullish on this category as private sector capex of low gestation is slowly picking up, and the government capex continues to be very strong. On the other part where we are bullish is banking and financials. The only change that we have made in the second half of 2018, which will continue into 2019, would be that of having a balance between corporate lenders and retail focused private sector banks. Overall tilt is towards private sector banks, but within that we have added some of the corporate lenders in the last few months, and we have quite a bit of balance between retail and the corporate focused banks within that entire basket.
Okay, fair enough. Harsha, give us your sense on how you would be looking at investing in technology. There's value emerging in mid-cap IT, even for the large cap names, despite what the currency has done. One is believing that the headwinds may be clearing out, or you don't think that would be the case, especially given the government shutdown fears in the US and how that would impact corporate activity and corporate investment?
We are not looking at making too many changes to our IT allocation. Currently, we are underweight or close to neutral in most of our portfolios on IT allocation, but most of our positions have been on the large cap space. That's where there is valuation comfort. The mid cap IT stocks, despite the recent correction, are quoting at a valuation which is much higher than large cap IT names. And also the business fundamentals are not so strong as compared to some of the large cap IT stocks. So overall, we remain cautious on the mid cap IT names, but remain invested in the large cap ones.
Okay, fair enough. What about how you would be looking at the rate sensitives? And within rate sensitives, my specific question is whether you're evaluating opportunities within real estate under RERA.
Rate sensitives, I think from here on they will have a easy scenario in terms of the business prospects. We do have some weightage on rate sensitives, but we are not looking to add anything in the real estate space, as we believe there is a large amount of inventory that's there in at least top 7 or 8 cities, and only after seeing that inventory going down we would see real improvement in the overall real estate space. So to that extent, we would rather play some of the other names which are rate sensitives than real estate. Having said that, overall consumption side, we remain negative. So we may not be looking at really aggressively building portfolio on the rate sensitives, because some of the consumption names which are also rate sensitive, such as automobiles, we continue to remain a bit cautious.
Right. And why is that, Harsha, that you're a little cautious on auto segment? Do you not believe that there could be a rebound which could come in auto sales in the months to come? I know there has been a steady decline that we've seen now in the last 3 months' data, and yes, rich valuations as well a concern with a certain few. But do you believe that this weakness is going to trail for sustained a few months?
In our opinion, it could continue for some more quarters. We have seen very strong growth across all segments of automobiles for the last 5 or 6 years, and in the last few months we have seen some moderation in terms of growth, and that is likely to continue in our opinion. And also the valuations really don't give much of room for any outperformance from here on, as most of these stocks still continue to be valued very richly. So to that extent, within consumption, we are not looking to aggressively add position to any of the names.
Okay, fair point. Great to have you on the show. Harsha, thanks so much for taking the time out, and here's wishing you and your entire team at Kotak a very
Thank you.
Happy and prosperous 2019.